Hello, and welcome to the BNP Paribas Asset Management Monthly Asset Allocation video. I'm Daniel Morris, Chief Market Strategist, and I'm joined by Maya Bhandari, Global Head of Multi-Asset. And this month we're going to be talking about geopolitics and markets. And I think in general, when we think about geopolitical crises, they're almost by definition unpredictable and therefore very challenging. When I think we as investors are used to having numbers and spreadsheets and things that we can predict, and this isn't predictable. So first question then is, how have you managed this over the last couple of weeks? What have you done with your portfolios?
So our multi-asset portfolios have taken two chief actions over this rather tumultuous period. Our first move on February the 23rd was to take advantage of the mini rally in equities on the prospect of soft global sanctions to protect portfolios from further geopolitical shocks. We reduced risk-taking or tracking errors to the cusp of neutrality and greater caution.
The timing seems to have been good. How did you go about that exactly?
Well, we halved our tactical risk positions towards European and emerging market equities and moved into cash. Now, both regions were vulnerable for different reasons. In the case of Europe, its sheer proximity to the unfolding situation and with investor positioning fairly full. And in EM, because it had been both strikingly resilient but also vulnerable, for example, to the disruption from the crisis on energy and indeed food prices that matter enormously for EM consumers. The second move was on the 2nd of March when we deepened our short duration position, really seeking to capture attractive valuations with an unaltered, and I should say cautious, fundamental perspective on core government bonds. I always say, Dan, that ultimately there are really only two reasons why a position should change. Either our fundamental assessment shifts or market valuations move, such that something becomes either more or indeed less attractive. And in this instance, our move was driven entirely by more attractive valuations to deepen our cautious stance.
If I could pick up on that move with duration, which I find quite interesting, because at this point, I think it's safe to say it's not obvious where yield should go from here. If we think about the story at the beginning of the year, it was higher treasury yields, people looking for 2.25%, 2.5%, and primarily driven by real yields, because for the most part, we saw inflation expectations pretty contained because we anticipated tighter monetary policy. Now, over the last couple of weeks, we've had a quite significant rally in real yields. At the same time, inflation expectations going up. Why do you think once we get a little further past the crisis, we're still looking for a rising yield environment?
Well, simply put, the conflict is on balance expected to add to already strong domestic inflation pressures, particularly in the US, but also in Europe and indeed globally. And with longer dated rates appearing much too low to us, risk-reward is asymmetric. So we are now at, as you reflected, Dan, close to the floor of nominal and real interest rates of the last 50-odd years, so quite a long time. And in our view, all the ingredients for higher bond yields are pretty much here. We have acute labor market shortages, large-scale stimulus rolling back faster than expected, globalization in reverse, and of course, an oil shock overlaid upon a larger and longer-lasting inflation shock from COVID-19. I should also add, perhaps, that longer term, the role of government bonds as a source of diversification for multi-asset portfolios is also highly questionable. Now, the nice thing about a bond is you are shown what you're going to be paid, and your starting yield is a fairly good indicator of the sort of returns you are locking in. And at 1.7, 2 or even 2.5%, you really aren't achieving much by way of a protective cushion.
We all hope that this crisis will be resolved quickly, and one of the consequences of that ideally would be a rebound in the markets, given that at this point they're pricing in not only what we know in terms of higher inflation and perhaps slower growth, but a lot of these uncertainties, the potential for more sanctions, and particularly the risk that there is an export ban on oil and natural gas from Russia, which we appreciate would be quite bad for the European economy. Nonetheless, you have to anticipate, hopefully, what's going to come in the future. Where do you think you might be looking to add risk when you feel it's the right moment?
Well, our most recent addition to risk was to add to our short duration position, which we just discussed. We also continue to stay long of commodities, a clear risk position, which we are currently running with a trailing stop of 3%. And our equity exposure today is concentrated in Japan, which combines, to our minds, a number of compelling factors. It's cash rich, attractively valued, supported by local policy, both top down and bottom up, and is relatively isolated from the ongoing conflict. So we feel relatively comfortable owning Japan at current attractive valuations. But while, of course, equities more broadly have fallen quite savagely in recent weeks, driven by derating, they aren't yet cheap, with the exception really of Japan, the UK, and now Europe. So if I look, for example, at forward PE valuations for global equities, we're still comfortably above the median of the last 10 years and in the top 40% also of valuations in the last decade. And of course, earnings expectations have not corrected lower yet, and there are clear downside risks. So all in, Dan, it's not clear to us that this is the time to buy a broader equity risk, as certainly further escalation of the conflict will impact earnings considerably, and there are many uncertainties as we reflected at the start. At the same time, any de-escalation would likely see punchy recoveries given the washouts we've seen in positioning. So we do need to be strongly tactical should the direction of travel in this conflict improve. I think it's fair to say, though, that the longer the conflict continues, the greater the downside risks are to both growth and indeed corporate earnings.
Thank you, Maya. If I could summarize what you've shared with us in terms of your positions where you have the highest conviction is the view that interest rates should go higher, so hence a short on duration. And you're most comfortable in terms of equity exposure with Japan, where you see attractive valuations and good earnings potential as we ideally return to the reopening environment that we had prior to the crisis. Thank you very much, Maya. I'm looking forward to speaking with you again next month.
Thank you very much, Dan, and likewise.